Please join me in welcoming Adelya A, the Vice President of Alexa Capital, Chad Blevins, the Managing Partner of Repower Holdings, Richard Toolen, the Founding Partner and CEO of Icon Asset Management, Jakob Pettersson, the Partner and CEO of Coeli Real Estate Funds, and Per Wimmer, the CEO of Wimmer Family Office.
Hi everyone, thank you very much for coming today. We are organizing this panel would be at the cross-section of energy transition and real estate. What we've heard earlier a lot, there is a lot of funds, infrastructure, capital that flew into energy transition over a long period of time. Here we're discussing a demand side. How is the built environment and energy transition of built environment reshaping the investment criteria of real estate investment in space? And so to discuss those themes, we are joined by esteemed panel, 4 panelists across different geographies. It's UK, Switzerland, US, and basically global presence that will help tease out the key trends in the space. What are really the value drivers that they see? And last but not least, really discuss the collaboration opportunities with the GCC region. So I would like now to turn over to the panel to introduce themselves. Per.
Yeah, my name is Per. I run Wimmer Family Office, Wimmer Financial, based out of London, originally from Denmark, but been here for 26 years. We focus primarily within real estate on UK and Europe, focus on value add, ground up, and some stabilized. We do both debt and equity, deal sizes 30 million and up, a lot of them sort of 50 to 100 to 150. We cover all subsectors of real estate, so everything from care homes, senior living, resi, commercial, hospitality, offices, you name it. And then we do a few other things as well, private equity and fund allocations, etc.
Thank you.
My name is Chad Blevins. Good to be here. I believe Mark earlier was talking about energy geeks, so I'm glad to profess myself to be an energy geek. In my career, I've been involved worked with a 30,000-acre coal mine, started up a company that developed 9 gigawatts of solar, sold that to BP, worked with an international real estate firm that set up a joint venture with Shell. So I think I've really lived the crossover between real estate and energy. And right now, I'm managing partner of commercial real estate investment firm, Repower Holdings. Our focus, as you can expect, and much of you would really understand, is really leveraging the energy transition to create the value in the operational side of a commercial real estate fund, or a $500 million real estate fund that we're bringing to the market right now, focused in the US, but we're really leaning into the value created on the exit and looking at a short-term hold period on the fund. Talk more about that later.
Thanks. My name is Jakob Pettersson. I'm with a Swedish investment firm called Coeli. I joined the firm and became a partner 8 years ago to start our real estate investment business. So we didn't have any real estate allocation at the moment, and we raised our first fund at that time. So we're building Nordic real estate portfolios. We're doing single asset deals for our clients who are primarily family offices and institutions. So the firm is going through rapid change and growth. We manage 7 billion euros as of today, and when I joined the firm a few years back, that was only 1 billion euros. So we're going through a large increase in inflow of capital and going into new regions and new investors. So I'm really glad to be here today.
Hello, everyone. My name is Richard Toolen. I'm here from Icon Asset Management in Zurich, Switzerland. We are an alternative asset management company. Basically, we work quite a bit with Swiss private banks and family offices. identifying non-correlated absolute return kind of projects, products, and bringing them to market. We are currently focusing on 2 new real estate and also data center, hydro data center projects. One specifically in Switzerland, where we have an acute housing shortage. It's kind of an interesting market unto itself. And also in Norway, where one of my partners is based, and we see quite a bit of demand there. Obviously, incorporating ESG hydro into data center and some other real estate projects there. So it's an interesting world, and we're moving into that based on investor demand that we're seeing in Switzerland.
Thank you, Richard. So let's step into the first question, first part of our panel, a really discussion of evolution of ESG. And we've heard ESG is an ambiguous word, so I'll use decarbonization of the built environment for our discussion. How do you see the evolution of this trend in all of your countries? And the answer would be different, depends whether you're in UK, Switzerland, Sweden, or US. So how do you see the trend and where we are today?
Well, I can perhaps pick up and start from where we are right now in the city of London, and where there's lots of offices around here. And if you look at specifically the UK and London office market, it's been a massive change, mainly driven by regulatory trends, demanding owners of office space to become a lot more ESG compliant. So what we have seen is a big push, and there's some deadlines that are coming fast and furious. But what it means is it has a very big impact on the market. Therefore, as an investor, for instance, into office real estate in London, you might look at an asset that looks great. It might be 5-6 years old, but I would argue that if more often than not, it's probably overvalued, because when these regulatory changes come through, making it more carbon neutral and more ESG compliant, you're going to have to invest a lot of money, and therefore prices will come down. Therefore, as an investment, it's probably better to look at some really old assets, and then really where the price is right, and then make them up top-notch, or indeed go for brand new offices, because this regulatory thing that is coming is very significant in the office space specifically, and it has a massive driver in terms of activities. And you do see a lot of buildings. People are coming back to the office now in London. It used to be Hong Kong was back and the Americans were not. And London was sort of in between, or Europe was in between, but now it seemed like it's back to the office most of the days, and therefore more spaces are needed. Certainly in the city and in Mayfair as well, where we see very big rent increases at the moment. You would have to go all the way to Canary Wharf if you need to do a very good deal, because nobody wants to be there.
Yeah, no, fair. Office space is really attractive investment, especially at retrofit area, given the reg push. Over to Chad.
So you're thinking about retrofits and thinking about how the ESG or the deep energy retrofit activity has changed over the last 10 years. It's really interesting. A lot of it was regulatorily pushed, but around about 2015, because rates were so low, it became really easy for energy service companies to approach owners of portfolios of real estate with financial mechanisms to finance just the energy project work, sort of separate from the real estate investment itself. And so you had a lot of energy service contract financing, you had power purchase agreement financing for the on-site energy generation, but then you also had equipment leasing solutions, and it worked. And you started to see firms approach real estate owners on a regular basis and start to talk our language and talk about, well, we're going to improve your net operating income, we're going to help you make your asset worth more. That's evolved over time, and certainly over the last year, as we've seen rates go up, fortunately, at the same time, we're starting to see more adoption at the investor side, the real estate side, incorporating those capital outlays into the commercial real estate investment itself. And so we're seeing ways to, project financing, that's becoming harder, but maybe let's set that aside and let's just look at it from a real estate investment perspective. And now we're starting to understand, okay, well, we can make this just part of our capital outlay on the front end, and then you get a much lower all-in cost of capital, and things still pencil out, and you actually see and are starting to recognize the value creation, not just through your operational NOI, but through preferential debt that you'll qualify for through your investment period, but then also to the next buyer down the line, improving your exit value, because now they're going to get better leverage when they're buying from your sponsors.
Makes sense. Thank you very much.
I think that in the Swedish and Nordic market, we primarily see the ESG push comes primarily today from the banks, saying that because the investors, they are like fluctuating. It's different standards that they want to go into over time, and that has somewhat changed. But the only thing that you can hold on to is the you actually can get 10 to 20 basis points better interest rates on your loans through ESG investments, and the banks. So I would say the banks are the only driver, except from of course the big institutional investors that are driving this theme or driving the market. Meaning also that they would push the entire market into making the properties better, and you can also get some sort of green finance through promising you're going to do future projects. But then of course the bank will also follow up on that after 18-20 months, so you better have done it. So I think it's a quite hard landscape to navigate in, because it's a bit hard to know which way you're going. And another example that's quite funny from the Swedish market, we have, as you might know, a large wood industry in Sweden. So one thing that a lot of companies did coming through this green phase was that they started to construct new residential products out of wooden frames. So there's no concrete, more the ground is concrete, and then there's wooden constructions all up. And that was a big investment team that all of the listed, the unlisted property developers in Sweden went for. And now, 2-3 years later, when you're getting to insure these houses, of course the insurance rates are like 5 to 10 times higher, because the frame is out of wood. So the risk of fire is probably a bit much higher. So that's also something that's quite funny, because there was a large push. Everyone was building modules out of wood, and then the insurance costs could be 5 to 10 times bigger, meaning that the more or less the entire profit from developing that house is gone, since the NOI is decreasing. And the developers were really trying to find. Then there was some Canadian insurance company that could take on this risk at a decent price. But that's also, I think, an example of how hard it is to navigate in this space.
I just want to respond to that real quickly, because it's interesting. We really look at the banks and how they're lending in Europe and in the Nordics, because we don't have in the U.S. nearly as robust of a financial industry that is leaning into green lending as you do in Europe broadly. If you look at the climate bonds that have been issued over the last year, 571 billion or something like that, over 50% of that's in Europe. And the U.S. is getting maybe 13% of the climate bonds that were issued. Now, in the U.S., we have a quasi-governmental entity, Fannie Mae, that does have a lending facility that's limited to multifamily investments, that offers preferential lending, lower rates, better terms. But there's a lot of overhead with that, utilizing that. And so one of the things that we're trying to solve for at our fund is really leveraging the mechanisms and sort of the frameworks for sustainability-linked loans and green bond principles that are really well established in Europe. We're trying to follow from that, use that at setting up our investments at the asset level to sort of pre-qualify our investments to position them to take advantage of the debt that is sort of becoming available following on the trend that's being set by European lending.
I would just add to that, it's not just the debt, it's also the equity, because you see a drive among some of the big equity allocators like pension funds, big insurance money, in their governance systems. They have a very strong desire to have it greener than green and ESG friendly, particularly in Scandinavia, of course, but also across Europe. So you see that pressure coming from the capital side. I mean, you can argue that ultimately comes from a regulatory and sort of political side, and maybe we take a bit of breather in the US at the moment, but certainly on the European side, it's still very much there.
Yep.
And that sort of translates also into the equity by allocating, because I remember when we see pitch decks coming in from real estate funds looking to raise money, you can see the same pitch deck that you saw 5 years ago. There's pretty much the same pictures and everything else, but now there are 7 slides about ESG and how we follow ourselves to be ESG friendly, and that's because pension funds and insurance money want that, and everybody feels good that way.
LP push.
Yes.
They want it, but they want detailed, actionable, reportable, measurable results following the net zero investment framework and Partnership for Carbon Accounting financial, so that they can really measure and prove on an ongoing basis. And a lot of assets are sort of going into it not prepared for that reporting overhead, and that's where they're falling flat. So they really need to look to the need of the pension funds, the sovereign wealth funds that have that interest, and be prepared, and then I think sail to that North Star.
Yep. And over to Richard, what do you see in Switzerland and continental Europe?
Well, in Switzerland specifically, I mean, it's been driven for the last 50 years, really. The building regulations are very stringent, and the zoning, and but also consumers in Switzerland would like, houses that are obviously energy efficient and ESG compliant, and willing to pay a premium for it. And also resale values are also higher for these houses, and older houses have been retrofitted and are now. So it's also not just driven from the regulatory side, but it's also driven from the consumer side, and just resale values, etc. So it's pretty much across the different stratum of Swiss society there, government and consumer, and so we see it from a couple of different aspects within Swiss society. So it's just a good investment for a couple of different reasons as far as Switzerland's concerned.
Thank you very much. Now, it's very clear, depending on geography, there is obviously different reg push, LP, really motivations, as well as different mechanisms how you can achieve the green premiums throughout different investments. So talking about the premiums, really, and where do you see commercial value today, and where do you see a space opening up for future opportunities in maybe one of your cases that you worked on or you're currently working on? It would be great to hear.
Yeah, I mean, you can see it, for instance, in hospitality. I mean, there's a case we're working on at the moment where there's a strong drive to have renewable energy, not just because we all feel great about it, but also because it actually makes economic sense. It's part of, it's a wellness retreat, so therefore it sort of ties nicely into it conceptually.
In UK.
But no, this is in Southern Europe, in Portugal.
Yep.
We love the Iberian Peninsula at the moment, by the way. We think it's, from a real estate point of view, Spain, Portugal, and in part also Italy. Southern Europe, I think, has some great opportunities at the moment from a supply-demand point of view, particularly on the resi side. But this is hospitality, and you can, by investing that little extra capex, benefit from cheaper loans, as we have heard. That's very much the case. Sometimes you can even also get some subsidies to get going if you have the right type of renewable. But more importantly, your operating cost in the long run does come down, and that helps a lot.
It makes me think of a couple different things. On hospitality in particular, you see a lot of these sort of middle-aged hotels where investors are picking them up to renovate them, clean them up, make them look a lot nicer, and reposition them. And invariably, they're adding electric vehicle charging to the parking lot. And what a lot of commercial real estate investors don't realize, and they get themselves into trouble with, is now you're adding a whole lot of additional load to that site, and you may start tripping up with the utility infrastructure. And so now they were thinking, oh, well, I'm just going to install a couple of chargers, and now the utility is coming over their head and saying, well, actually, you have to completely upgrade your grid hookup, and that's going to cost you a lot of money, and it's going to blow out your investment. So now those investors who are thinking this through are saying, okay, well, in that case, I'm going to also add a lot of covered parking while I'm installing that EV charging. And if I'm doing covered parking, I'm going to put solar on top, and I'm going to put battery storage, not for the cars, but for the EV charging to act as a regulator so that the solar charges the batteries then work the EV chargers, and I'm not doing any massive pull of electricity from the utility grid, and so now I don't have to upload the utility grid. So you've got to sort of do this integrative design process, and in that case, it's just a matter of adding the amenities to the hospitality. You want to offer EV charging to make it a worthwhile renovation investment, and that's what's driving the need to have on-site generation, because you're sort of solving for reducing a different type of capital cost. And in the meanwhile, energy prices are really volatile, and sort of they're harder and harder to project. There's really low electricity prices in Texas right now, but there's rules going through the Texas legislature that may really increase the electricity price. So if you don't have a lot of robust on-site generation, or an extended plan to really make your property more energy efficient, then you're just leaving yourself more exposed. So as a risk management play on your investment, you want to reduce your exposure to that utility expense as much as possible.
Yeah. No, thanks, Chad. We definitely see that on corporate finance side as well. In the UK, retrofit is a huge opportunity. In some other European countries, there is definitely scale in US for on-site generation and really being smart about energy bills. So that definitely resonates. And Jakob, how about in your area of coverage in Sweden and Nordics?
What's a deal that we're working on at the moment, which is quite interesting, is a central office deal in Stockholm, where we see a few types of value creation. We still even though the Swedish and Nordic market is very liquid from a European perspective, there's still a large private ownership in the market, and even high quality assets in the central of the city, as the one we're looking at the moment, is privately held, meaning that even though those families that own it, they're going through a generational shift. They haven't really, they haven't invested in their property, and because they don't really have to bother. Because they have so much assets. So I would say it's still finding the right type of investments, buying out of the right owners can be a quite easy way to leverage on the ESG trend, because at first, the office market has been struggling throughout the world. So there are vacancies that you can work with. You can fill it up with tenants who are going into smaller areas or smaller office premises that still want to be centrally located. But at the same time, the families that has been owning the assets, they haven't invested in the house. So you can do a lot of things on the energy side. So I think it comes down to the deals and the types of sellers that you find, and making them quite easily from like brown to green investment, and then if the location is right, you can sell them onwards to the institutional pension funds that wouldn't want to do the rental work, that wouldn't want to do the investment work on the efficiency side.
No, thank you. So institutionalization of the real estate, kind of what you're describing is buying from private owners and actually greening the property. That's where you see the yield, basically.
Yeah.
makes sense. Richard?
And I guess Switzerland specifically has always had kind of a love affair with hydro. I don't know, many people don't know, like 65% of Switzerland's electricity is generated via hydro power and hydroelectric power plants. And so and now we have this huge, obviously, demand for electricity from a lot of these data centers. So, I mean, what we're seeing now is a demand to try to combine, the benefits of hydro and the ESG aspect of that with this demand for the power that we're going to need to run all these data centers and for cloud computing and AI and everything else that's coming, quantum computing. So one of our projects specifically in Norway is trying to combine those aspects with the hydro, with the data center. And we are actually seeing even now in Switzerland, which I know is a little bit controversial in some countries like Germany, but they are fully on board with building more nuclear and to be completely self-sufficient and off the electricity grid of the rest of Europe in terms of like not needing to import electricity from anywhere. So for strategic reasons, kind of like Swiss self-sufficiency, if you will. So there's a couple of different interesting aspects of political, ESG, and just new technology, electricity generation demand coming into play here in Switzerland specifically.
I can perhaps pick just to emphasize Richard's point there. I mean, I think few of us realize the drive of AI, what that's going to entail in terms of energy needs. It is off the chart, absolutely off the chart. AI over the next 5 years are going to consume so much energy that today is nothing in comparison. So the question is, how do we accommodate that? What do we do about it? A few years ago, I wrote a book about green energy and green energy generations called The Green Bubble, and it's about how to make good policy in that regard. And there's basically 3 conclusions on it. Number 1, hydro. Hydro is beautiful because it's big capex, but once you've done it, it just keeps giving, and it's base load. And the problem you have a lot of renewable is it's intermittent, so you need backups. So every time you put another megawatt of solar, you need another megawatt of gas fired just in case the sun is not shining or the wind turbines are not working. So, but hydro is a very key element of it. It does require rivers, of course, but Sweden, Norway, and other places, Brazil, are massive beneficiaries of that. Secondly, nuclear. Whether you like it or not, there's no future without nuclear. You cannot have enough baseload generation without serious nuclear generation. It's just impossible. Here in the UK, if you go down to Hinkley Point C, the new nuclear station is coming online, that alone will account for 7% of all electricity consumption in the UK once it's on stream. So very significant. And then the third one is efficiency. If you can reduce the consumption, that's as good as producing. So LED lights that, consumes 10% less than normal bulbs, etc. So wherever you can insulate, wherever you can put efficiencies in place, that's also a huge part of the market and a huge part of the solution. So these are the 3 basic things. And all the other things are needed as well. But without those key things, we're going to have a big problem, energy generation, from a renewable point of view. But this is part of the solution.
I want to add just like one additional point on that is with respect to data centers, something that we've seen from the real estate side of sort of data center investment. A lot of the deals that are coming through are really split across multiple parties that are each sort of doing their own piece of the investment. So you've got the real estate investor looking at the land co. They've got to develop the land, the property, have the power availability. You've got the operational co coming in, developing the power center. And often we have a completely separate SPV setting up the microgrid to power the system. And the push is like, how fast can you get me online? What's the time to online? And the delay is like, well, there's so much power needed by the data center that the grid can't, upgrade fast enough to be available. Well, okay, well then we want to have a microgrid come online. While everybody starts developing microgrids, now we can't get the gas turbines fast enough. They're all, on order backlog. And so now everybody's looking for ways to sort of phase in their modular build out of the data center in line with how fast they can get the power to match. And so you've got the real estate investors trying to structure their investment in a way that will sort of maybe bring in as much at the power generation on the small side to support phase one of the data center, while phase two of the data center is going to be supported by a microgrid as soon as it's able to get its turbines in place. Phases 3 onward are looking at, okay, well, we're going to have, larger SMRs in place, but those maybe, aren't going to come online until the 2030s. And so it's complicated is what I'm saying, but it's interesting.
So as we already discussed, and I think everyone would agree, energy transition is very messy. We came back full circle talking about baseload power, development of SMRs for data centers, and the list goes on. So maybe I'll use that as a leeway to kind of go into the last section of our panel and really discuss the collaboration opportunity with the Gulf region. As it was previously said by Majid, it's a patient capital that is able to tolerate a little bit higher level of risk at times than private capital. So how can we kind of get together and summarize some of the things that you see here on the panel in terms of that collaboration, partnership, technology transfer? Over to you.
Well, there's plenty of opportunities for collaboration. It is interesting to see, our previous speaker was talking about Saudi and about what's going on there. And obviously, if Saudi did not go the renewable route, alternative route, they would end up consuming so much eventually of their oil resources, which is bad business. Better to export it, make the big profit margin, and then invest in real estate and in renewables. We see in Norway produces 2 million barrels a day, and yet Norway is very much a renewable country. And has a lot to offer in that regard. I think the biggest number of EV cars are being sold today in Norway on a worldwide basis. So it's a massive challenge ahead of us. We need to collaborate on technologies. Those who have them, those who are leaders in the field, need to share it and expand that way. And then above all, we also need to get the politics right, because at the moment there are a bit of headwinds in certain parts of the world. But I think the companies must seize the opportunity, particularly where there's leadership. And it's also growth. If you can bring technologies to other parts of the world, it's growth, and it becomes a win-win, not a win-lose or I sell to you. It's genuine joint ventures that are needed here. And that's what we need to focus on.
Thank you, Per.
Yeah, absolutely. There's a lot of learning that can go in both directions, and a lot of collaboration. I think, Per, you earlier sort of mentioned that we're maybe slacking on the leadership side of pushing ESG at the U.S., but that's really secondary to the activity that's taking place in the U.S. commercial real estate market. It's really opened up to its international investment or international market. I think we're seeing a lot of the investment funds engaging international capital and trying to frame our investments, certainly we are with our fund, to match the interest of capital internationally. And so we're kind of like set the U.S. federal government aside. We're looking to engage, and so we're looking to say, well, where's the largest and most adopted frameworks for what sustainable investment looks like, and how are people managing their verifications, their standards, their reporting, and we're setting up that way. So when I think about what the GCC is doing, there's so much new construction taking place. There's a lot to be learned there. I want to engage with those developers and look for ways that we can take what they're learning how to do and see more construction take place in the U.S. following on those best practices?
Jakob.
No, I totally agree, and I think that there needs to be a lot of things to transfer between the continents, because if you look at where we operate in the Nordics, there's like by itself the market has due to climate more or less the market itself has been in the front end of the ESG and the agenda coming to high energy prices, cold climate, but there needs to be so much ways that you can exchange technologies with the GCC. So I totally agree on that.
Yeah, and I would just say that the Swiss financial services industry, obviously, concentrating quite heavily on wealth management and advisories, working quite closely with the GCC investors in finding these kinds of projects where there's knowledge transfer between both countries and mutually beneficial, obviously. And so we do see a lot of that at the moment between Switzerland and GCC investment entities.
Thank you very much. Well, this is the end of the panel. I want to thank everyone for the presentation, and thank you very much.
Thank you.